Hey everybody, it's Janine here, and today I wanted to talk to you about what investing is and why it is so important that you get started. So what is investing? Investing is a way to grow your wealth. We hear a lot of fear-mongering in the news about how millennials have chosen not to invest and how our parents' generation was really hurt by the stock market in, the early 2000s with the dot-com bubble, and then again in 2007, 2008 with the financial crisis. But what investing is it's a way to make your money work for you and grow your wealth in the long term so that you do have to save less for retirement. When it comes to investing, you really don't need a lot to get started. You can start with as little as $25 or $50 if you're looking to start investing with your financial institution or bank. And if you're interested in getting started with a brokerage account, you can start with as little as $1,000. So there are a couple different ways that you can start investing. The first obviously is through your financial institution. So if you bank with Tangerine or TD or RBC, typically they'll have some sort of mutual fund available for you as an investor. The alternative to this is investing through an online brokerage such as Questrade, which is what I use to invest in my TFSA and my RRSP, and this allows me to purchase stocks and ETFs and index funds as well as mutual funds for a very low fee. Typically, some of these discount brokerages will have a lot lower fees than your financial institution. So when you're starting out investing, all of this can seem very overwhelming. There's a lot of different acronyms. What's an ETF? What's a mutual fund? And some people just don't know where to start. So I wanted to run through quickly on a high level what the difference between mutual funds and index funds as well as ETFs are and why those might be a great place for you to get started. So all of these three funds that I just listed are great ways to get started in investing because they allow you to diversify your portfolio. What that means is you're not throwing all of your money into one stock that potentially could go up and down volatilely with the market. Mutual funds, index funds, and ETFs allow you to own many different companies at once, and therefore you reap the rewards of having stocks and ownership in different industries across Canada, the US, and even the world. Mutual funds typically have a little bit higher of a fee associated with them as opposed to an index fund or an ETF, so this is something to look out for. Really, you can get anything you want with an ETF. There are ETFs that invest in certain indices as well as certain industries, so you can really have your pick at what you want to invest in if you're looking at an ETF. Similar to ETFs, index funds do just follow a specific index. That would be like the Dow Jones, the S&P 500, or the TSX. They follow the performance. They're a very passive investment, and you just reap the rewards of what the market gives you over the course of 5, 10, 15, 20 years of holding those index funds. When you're getting started, this is so important because you are looking for long-term investments. You're looking to buy and hold and invest to grow your wealth over the long term, so you don't want to get scared by the market. If you can, start an automatic contribution to your investment account that allows you to purchase ETFs, index funds, or mutual funds, and do it on a monthly basis. Remember that you can't time the market, and it's so important to start investing on a monthly basis so that you can take advantage of dollar cost averaging. So what dollar cost averaging is ensuring that you get the highs and the lows of the market. So again, you're not trying to time the market. You're purchasing when the stocks are low, but you're also purchasing when the stocks are high, so it averages out to a really nice purchase price over the course of your investment. I just wanted to touch quickly on the difference between an investor and someone who has chosen to just keep all of their money in a savings account. So the best savings account I've seen these days is about 2.3%, whereas if you're looking at the stock market, and investing in an ETF, you might be looking at returns in the 8 to 10% per year range. So why this is important is, for example, if you're 25 and you have $25,000 invested and maybe you're going to contribute $5,000 a year to your investment, by the time you reach retirement, there's going to be at least $1 million difference in between the person who chose to invest in stocks and the person who kept their money in a savings account. And I've gained this knowledge through my favorite retirement calculator, which I've linked in the comment section below, so feel free to take a look at it. It's a great little calculator, and it really outlines why you need to start investing right now. If you liked this video and you thought the information was valuable, please give it a thumbs up and subscribe to my channel. As well, if you have any questions or comments, please feel free to leave them in the comments section below. See you soon.